Friends, in today's video, we will discuss Motilal Oswal Small Cap Fund. We will learn how this fund's performance has been, what its investment strategy is, how much risk it carries, and whether we can consider this fund for lump sum investment or not. So first, let us discuss this fund's returns. Motilal Oswal Small Cap Fund has delivered outstanding returns in its first year. Since it is only about a year old, longer term performance data isn't available. However, despite market fluctuations, the fund has shown remarkable resilience and strong returns, as it has given 25% returns, whereas the small cap fund category's returns are only 11%. So it has outperformed its category by a huge margin of 14%. And since its performance has been outstanding last year, it has also become the number one fund in its category. Now, based on just 1 year's performance, we can't comment much about a fund. However, this is also important to note that it has outperformed all the established funds and after coming into existence has taken the top position in the category in just 1 year. Further, this fund comes from a very reputed fund house, Motilal Oswal Fund House. Almost all schemes of this fund house have given very good returns in the past 5 years, ever since the market recovered after the COVID crash. This is because Motilal Oswal Mutual Fund has changed its investment strategy. Now the fund follows an aggressive investment strategy and keeps its portfolio highly aggressive and concentrated in almost all in its schemes. And Motilal Oswal Small Cap Fund is no exception. Fund invests in high growth companies which also tend to be high PE companies. So the mutual fund scheme can get higher growth. At the same time, fund keeps its portfolio highly concentrated as fund doesn't invest in too many shares so that its returns don't get diluted, and therefore fund succeeds in generating higher returns. However, at the same time, if we discuss this fund's short-term performance, it has been quite disappointing. This fund has generated negative 15% returns in the last 6 months, whereas the average returns of the category are only negative by 9%. Thus, it has underperformed its category averages. Similarly, if we discuss about YTD returns, that is from 1st January till now, here too it is underperforming the category averages. Though not much, as during this period category has given negative 13% returns while this fund has given negative 15% returns. So while its 1 year performance is outstanding and it has outperformed category averages by 14%, but its near term performance, that is in last 6 months, has been disappointing. And the reason for this is the controversy linked with Motilal Oswal Mutual Fund and Kalyan Jewellers, due to which all schemes of this mutual fund house were negatively impacted, and Motilal Oswal Small Cap Fund is no exception. This fund's performance was also negatively affected due to that controversy, and as a result, the mutual fund house had to slightly change its investment strategy. It has to become a bit defensive. Its investment strategy was disrupted. However, now this controversy linked to Kalyan Jewellers is over. So going forward, this controversy will have no further impact on this fund. Whatsoever losses had to happen already happened, whether that is the loss of reputation or loss in the review of the fund. And one more thing that needs to be understood more deeply is that the performance given by Motilal Oswal Small Cap Fund of providing 25% returns in 1 year against the category average of 11% was given despite the controversy. Even after adjusting for the poor performance in the last 6 months due to that controversy and also due to the downturn in the markets, it has still given such good returns of 25% in 1 year and outperformed category by a huge margin of 14% despite the controversy. So this fund has shown a lot of resilience, and even if a controversy is linked to it, even if its short-term performance is hit, despite that, this fund has the capacity to generate excellent returns. This is a point in its favor and creates confidence for investors. Now let us understand fund's investment strategy a little more deeply. First, as you are aware, Motilal Oswal Mutual Fund House has given outstanding performance in last 5 years. After the COVID crash, when the market recovered, this fund has benefited most from that apart thanks to its changed investment strategy. Now this fund follows a highly aggressive growth investment strategy. This fund invests in high growth shares, and when you go for investment in high growth shares, naturally they will also be high PE shares. So it invests in high PE, high growth shares where there is a very good growth potential ahead, and companies are already doing well, and most of the times valuations of such companies have already become expensive in the market. Motilal Oswal Small Cap Fund and also other schemes of Motilal Oswal Mutual Fund AMC invest in such shares only. This is why this fund's PE ratio is at 31, which is quite high for the market. But as already discussed, if you go for high growth shares, good companies, they will be available in the market at a high PE only. This investment strategy is rewarding them well as their performance has continuously improved over the last 5 years in almost all schemes of Motilal Oswal Fund House. Even this fund, despite its Kalyan jewelry controversy, which caused a dent in its NAV, has absorbed that impact and still generated outstanding returns of 25% last year. Funds that follow a growth investment strategy also keep a very concentrated portfolio. So this fund portfolio is also quite concentrated as this fund keeps very few shares in its portfolio. This fund has only 49 shares in its portfolio, whereas the small cap fund category's average holding is 95 shares. So against that, it has almost have the half the number of shares in its portfolio. Now 49 shares are not too few. They still provide a good amount of diversification. So you cannot say that the fund is overly concentrated and lacks diversification. Sufficient diversification is achieved even with 49 shares. Further, if you increase the number of shares, your returns also get diluted. So if you expect outstanding returns from this fund, you cannot expect this fund go for a more diversified approach. Also, if you want to generate better returns compared to market, you will have to go with the growth investment strategy, whose characteristics are high PE shares and a concentrated portfolio, meaning the number of shares in the portfolio is kept low. The fund also has some other positive points, such as its portfolio turnover ratio is very low at only 50%, whereas the category average is 126%. This means it churns its portfolio much less compared to the other small cap funds. It does not frequently buy or sell shares in its portfolio. Instead, it invests with conviction in high growth, high PE companies and holds them for growth. Another positive point is its expense ratio, which is at 0.42%, whereas the category average is 0.57%. So it is 15 basis points lower than the category, which ultimately benefits the investors of this mutual fund. Now let us discuss whether we should invest in this fund, particularly for lump sum investment. Here, one thing is very clear. Smart investors wait for such opportunities when there is a decline in the market and they get a chance to buy at lower valuations. And market is throwing this opportunity right now. If you want to invest in a fund or in a stock, you can grab this entry point provided by the market. Although the market has seen quite a recovery in the last week, it is still far below from its all-time highs. Market may go or may go down from here. No one knows. Markets can move in any direction. But if you have to invest, and when you are getting the opportunity to invest at more than 10% below the peak, then that may be a good entry point. However, it is very important that if you decide to invest a lump sum amount, you should invest it in installments and not the entire amount in one go. Now, whether you divide it into 3, 5 or 10 installments depends on your risk tolerance and investment psychology. However, investing the entire lump sum amount in one go is equivalent to speculation, because if you invest the entire amount in one go and the market starts falling further from here, it will be very painful to you. However, if you distribute the same investment in installments, you will get an average price in the market, which will be neither the peak nor the bottom. Further, this is also the standard method for lump sum investing. This video is for educational purpose only and is not an investment advice or recommendation. Always conduct your own research or consult a financial advisor before making any investment decisions.